Let's take a look at currencies. We are joined by Shaun Osborne, Managing Director and Chief FX Strategist at Scotiabank. Great to see you.
Nice to be here.
You are seeing an unusual pattern in the market right now. US stocks have been under pressure, and the US dollar has been weak as well. And tell us why that usually doesn't happen.
Right, so it's kind of an unusual situation right now where, not necessarily on a day-to-day basis, but generally we've seen a pattern of broader weakness in US assets. Equities down, bonds down, and the US dollar down as well. And that's kind of unusual for markets generally, because typically when we see, for example, equity markets weaken, the US dollar as a safe haven asset typically catches a bit of a bid. It strengthens in response to those kind of situations. We're seeing right now, particularly this week, a rather unusual shift in that relationship. And it's meaningful for Canadian investors because typically if you have a US dollar-denominated portfolio, stocks, for example, and equity markets fall, you typically get a bit of a cushion from that weakness, from the strengthening in the US dollar. We're not seeing that right now. So the Canadian dollar is actually strengthening, typically, when we've seen equity markets weaken. So that actually amplifies the negative return that Canadian investors would feel from their US stock portfolios if they're not hedged for FX risk.
I know we get into investing philosophy here, but as you know, there's a whole bunch of ETFs out there that hedge for the currency.
Right.
What is your view on those? I mean, it will be a US tech ETF, but it hedges against US dollar weakness.
Yeah, I think generally for most retail through institutional investors in Canada, I would say that FX risk, particularly in the last few years, has probably not been hedged sufficiently or adequately because we have this relationship typically with the US dollar appreciating when US equity markets fall. And I think that maybe breeds a bit of complacency, or has bred a bit of complacency for Canadian-based investors. It's very, very unusual to see this kind of relationship. The last time we saw it was back in 2017, when the Canadian dollar was under pressure. US equity markets were rallying amid the tariff NAFTA renegotiations back then. So it's very, very unusual to see this kind of relationship between the CAD and equities. And it will affect people's returns or investor returns, and probably will see a shift into, I think, or drive a shift into more hedged assets going forward.
That carries a cost, though, I suppose. I mean, hedging isn't free.
Hedge is not free, no. But generally the returns, you wouldn't fully hedge necessarily the entire equity portfolio or the entire FX risk. You'd hedge a portion of that. We typically say when we're talking hedging with clients, 50% is the hedge of least regret. You've hedged some, but you haven't necessarily hedged everything. Yeah. But we may well be moving into an environment where we see this trend persist given I think the uncertainties that have been driven by US trade policy, US economic policy, fiscal policy, the confrontations that we've seen between the President and the US Federal Reserve about where interest rates should be. There are a multitude of factors, I think, shaping up here or ranking up here that mean that investors are going to take a very close look to their exposure to US investments going forward, and may need to hedge the risk of a combination of weakness across US assets in their portfolios.
And just remind us, how has the Canadian dollar been doing against the euro?
So it's been pretty range-bound, actually. The broader range, the euro's been relatively strong. The CAD has underperformed in the past few months. The EURCAD cross has been trading close to sort of 155, 160, that sort of range. It's been a fairly disciplined range, I would say, overall. That range probably will continue, I think, in the short run. We're looking at an environment where maybe the CAD is going to pick up a little bit of ground here. We are looking for end-of-year forecast of 72 cents for the Canadian dollar, but we're already trading very close to that right now. And in the short run, it does look as if the Canadian dollar may pick up a bit more ground, a reflection of general US dollar softness. We can see that there's been a pretty big shift in market sentiment regarding the dollar outlook over the last little while, and that includes the Canadian dollar outlook. So it does appear as if we're moving into a new higher range for the Canadian dollar, at least in the short run. That may be something in the range of 72 to 74 cents. But generally speaking, you know, when the dollar has, historically, when the US dollar has underperformed, it's been mainly because of these big structural challenges that the US has encountered over the last 30 or 40 years. And that generally means deficits. So big deficits usually worry investors, and that has in the 80s and particularly in the early 2000s. Twin deficit story was a big driver of dollar weakness. given the fiscal situation in the US, still to be resolved fully, but as the tax bill progresses through Congress, investors may be concerned about how fiscal policy dynamics are going to shape up in the next few years. And I think that could add incremental pressure on the US dollar generally.
Yeah, there are fears that neither big political party in America cares about the deficit or is talking much about it.
Well, I think there's been a lot of resistance to actually dealing with deficits historically, right, regardless of whichever party's in power. Yeah. Deficits don't matter until people want their money back. We may be in a situation now where investors are starting to wonder a little bit more, given the recent downgrade, of course, to US sovereign credit. Mm-hmm. People are starting to wonder about the sustainability of US fiscal policy a bit more intently.
It is interesting that the Canadian dollar is not far off 72 cents, given the weak oil price, given the fact we've cut interest rates so much, yep, and the tariff threat to our very open economy. It's kind of surprising in some ways.
Yeah, the tariff crosshairs are a bit of a moving target right now. So the euro has probably underperformed a little bit today because we had some headlines earlier on from President Trump suggesting that he was going to levy a 50% tariff on Europe, the European Union rather, as of June 1st. Mm-hmm. So in terms of market sentiment, that may be weighing a little bit more on the euro relative to the Canadian dollar, at least in the short run. We've seen before, though, that these tariff threats, maybe no more than that, at least. We get to the deadline, they're extended, they're modified or moderated to some extent. So it's not entirely clear that we're going to get a 50% tariff on the European Union at this point, but that's nevertheless a threat. And that may mean the euro underperforms in the short run. But the CAD's trading relatively well right now. It's about where we think it should be, according to our fair value estimate, which is right around current levels today. Some things have moved in the CAD's favour, so the dollar generally weakening, certainly a factor. Interest rate differentials have moved a little bit in the Canadian dollar's favour. That's also helpful. But the CAD seems to be pretty well positioned right now. It's not stretched either one way or the other, and it has room to improve.
Okay, room to improve. I guess we all do. Shaun, thank you very much indeed. Shaun Osborne, Managing Director and Chief FX Strategist at Scotiabank. I really appreciate it.